Welcome to this review of General Mortgage Knowledge. This video will give you a clear, straightforward overview to boost your confidence before test day. We'll cover conventional versus government-backed loans, mortgage products, fixed, adjustable, balloon, and HELOCs, and qualified versus non-qualified mortgages. And be sure to like and subscribe so you don't miss future reviews, and don't miss what's happening in the lower corner. There's a study hack that could give you an edge on exam day. Let's get started.
General Mortgage Knowledge. Loan types: conventional, FHA, VA, USDA. Which loan type typically requires a minimum down payment of 3.5%? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is B, FHA. FHA loans are designed to help low to moderate income borrowers who may not qualify for conventional loans. They require a minimum down payment of 3.5%, making them accessible to more borrowers. Which loan type is specifically designed for rural property buyers? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is D, USDA. USDA loans are aimed at helping low to moderate income families purchase homes in rural areas. They offer benefits such as no down payment and reduced mortgage insurance costs.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which loan program is available exclusively to eligible veterans and active duty military members? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is C, VA. VA loans are a benefit for eligible veterans and active duty military members, offering advantages like no down payment and no private mortgage insurance, making them highly attractive. What is the typical loan-to-value ratio requirement for a conventional loan without private mortgage insurance? Is it A, 80%, B, 90%, C, 95%, or D, 100%? The answer is A, 80%. Conventional loans without private mortgage insurance typically require an LTV ratio of 80% or lower, meaning the borrower must make a 20% down payment to avoid PMI. Which loan type does not require mortgage insurance regardless of the down payment amount? Is it A, conventional, B, FHA, C, USDA, or D, VA? The answer is D, VA. VA loans do not require mortgage insurance, regardless of the down payment amount, which is a significant advantage over other loan types, reducing the overall cost for borrowers. Which loan type is known for allowing the use of gift funds for the entire down payment? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is B, FHA. FHA loans allow borrowers to use gift funds for the entire down payment, making them accessible for those without substantial savings. Conventional loans typically have stricter requirements regarding gift funds. Which loan type often requires a funding fee that can be financed into the loan? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is C, VA. VA loans include a funding fee that helps reduce the loan cost to taxpayers. This fee can be financed into the loan, unlike conventional loans, which do not have such a fee. Which loan type is typically associated with lower credit score requirements? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is B, FHA. FHA loans are known for lower credit score requirements compared to conventional loans, making them accessible to borrowers with less than perfect credit histories. Which loan type requires the property to be located in a designated rural area? Is it A, conventional, B, FHA, C, VA, or D, USDA? The answer is D, USDA. USDA loans are designed for rural area homebuyers and require the property to be in a designated rural location, promoting homeownership in less densely populated areas. Which loan type allows for 100% financing, meaning no down payment is required? Is it A, conventional, B, C, VA, or D, USDA? The answer is C, VA. VA loans offer 100% financing for eligible veterans and active duty service members, eliminating the need for a down payment, unlike conventional loans that typically require at least some down payment. Which loan type typically requires a debt-to-income ratio of 41% or less for qualification? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is C, VA loan. VA loans typically require a debt-to-income ratio of 41% or less for qualification. This helps ensure that borrowers can manage their monthly payments comfortably, reducing the risk of default. Which loan type provides a guarantee to the lender rather than insurance, reducing risk in case of borrower default? Is it A, conventional loan, B, FHA loan, C, USDA loan, or D, VA loan? The answer is D, VA loan. VA loans provide a guarantee to lenders, minimizing their risk if a borrower defaults. This guarantee is a key feature, distinguishing it from other loan types that rely on mortgage insurance.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Which loan type may require an upfront mortgage insurance premium at closing? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is B, FHA loan. FHA loans require an upfront mortgage insurance premium at closing, which is a percentage of the loan amount. This helps protect lenders against losses from borrower default. Which loan type is specifically designed for borrowers with moderate income limits and rural property locations? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is D, USDA loan. USDA loans are designed for borrowers with moderate income limits purchasing homes in designated rural areas. They offer benefits like no down payment and lower mortgage insurance costs. Which loan type allows sellers to contribute up to 6% of the sale price towards closing costs? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is B, FHA loan. FHA loans allow sellers to contribute up to 6% of the sale price towards the buyer's closing costs, making home purchases more affordable for buyers by reducing their out-of-pocket expenses. Which loan type is most likely to require private mortgage insurance if the down payment is less than 20%? Is it A, FHA loan, B, VA loan, C, conventional loan, or D, USDA loan? The answer is C, conventional loan. Conventional loans typically require private mortgage insurance if the borrower makes a down payment of less than 20%. This insurance protects the lender in case of borrower default. Which loan type is specifically designed to assist low to moderate income borrowers in rural areas? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is D, USDA loan. USDA loans are tailored for low to moderate income borrowers purchasing homes in designated rural areas. These loans often offer favorable terms, including no down payment requirement. Which loan type provides a guarantee to the lender, reducing their risk if the borrower defaults? Is it A, FHA loan, B, VA loan, C, conventional loan, or D, USDA loan? The answer is B, VA loan. VA loans provide a guarantee to lenders, reducing their risk in case of borrower default. This guarantee is backed by the Department of Veterans Affairs, not insurance. Which loan type allows for the entire down payment to be gifted from a family member or close friend? Is it A, FHA loan, B, VA loan, C, conventional loan, or D, USDA loan? The answer is A, FHA loan. FHA loans allow the entire down payment to be gifted by a family member or close friend. This flexibility helps borrowers who may not have sufficient savings. Which loan type typically includes an upfront mortgage insurance premium that can be financed into the loan? Is it A, FHA loan, B, VA loan, C, conventional loan, or D, USDA loan? The answer is A, FHA loan. FHA loans require an upfront mortgage insurance premium that can be financed into the loan amount, making it easier for borrowers to manage initial costs. Which loan type is typically associated with the requirement of a certificate of eligibility? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is C, VA loan. A certificate of eligibility is required for VA loans, which are exclusively available to veterans, active duty service members, and certain members of the National Guard and Reserves. Which loan type may allow a borrower to finance the upfront guarantee fee into the loan amount? Is it A, conventional loan, B, FHA loan, C, VA loan, or D, USDA loan? The answer is D, USDA loan. USDA loans allow borrowers to finance the upfront guarantee fee into the loan, making it easier to manage initial costs. This is beneficial for eligible rural and suburban home buyers. What is a key characteristic of a conventional loan compared to government-backed loans? Is it A, not insured by the government, B, requires mortgage insurance for all loans, C, available only to first-time homebuyers, or D, allows for 0% down payment? The answer is A, not insured by the government. Conventional loans are not insured or guaranteed by the government, unlike FHA, VA, and USDA loans. This often results in stricter qualification criteria, such as higher credit scores. Mortgage products: fixed, ARM, balloon, HELOC. Which type of mortgage typically has a fixed interest rate for the entire term of the loan? Is it A, adjustable rate mortgage, B, fixed rate mortgage, C, balloon mortgage, or D, home equity line of credit? The answer is B, fixed rate mortgage. A fixed-rate mortgage maintains the same interest rate throughout its term, providing predictable monthly payments. This contrasts with adjustable-rate mortgages, which have variable rates. What is a key characteristic of a home equity line of credit? Is it A, fixed monthly payments, B, one-time lump sum, C, variable interest rates, or D, no repayment period? The answer is C, variable interest rates. HELOCs allow borrowers to access equity in their home as needed, similar to a credit card. They typically have variable interest rates and a draw period, followed by a repayment period. How does an ARM differ from a fixed-rate mortgage? Is it A, interest rates can change over time, B, interest rates are constant, C, they have no closing costs, or D, they are only available for short terms? The answer is A, interest rates can change over time. ARMs have interest rates that change at specified intervals based on an index, while fixed-rate mortgages maintain a constant rate throughout the loan term, affecting payment stability. What happens at the end of the term for a balloon mortgage? Is it A, the loan is automatically refinanced, B, a large final payment is due, C, monthly payments increase significantly, or D, the interest rate resets to a new fixed rate? The answer is B, a large final payment is due. Balloon mortgages require borrowers to make a large final payment at the end of the loan term. This payment covers the remaining balance, which can be significant. Which mortgage product is most suitable for someone planning to sell their home in a few years? Is it A, fixed-rate mortgage, B, balloon mortgage, C, HELOC, or D, adjustable-rate mortgage? The answer is D, adjustable-rate mortgage. An ARM can be advantageous for short-term homeowners due to lower initial rates, which can lead to lower payments if the home is sold before the rate adjusts. What is a distinguishing feature of a balloon mortgage? Is it A, the interest rate adjusts annually, B, the loan is interest-only for the entire term, C, a large payment is due at the end of the term, or D, the loan term is typically 30 years? The answer is C, a large payment is due at the end of the term. A balloon mortgage involves smaller periodic payments followed by a large lump sum payment at the end of the term. This structure can be beneficial for those expecting significant future income. How does a home equity line of credit differ from a traditional mortgage? Is it A, HELOCs have fixed interest rates, B, HELOCs offer flexible borrowing and repayment options, C, HELOCs require a down payment, or D, HELOCs are used for purchasing homes? The answer is B, HELOCs offer flexible borrowing and repayment options. A HELOC allows for borrowing against home equity with flexible withdrawal and repayment terms, similar to a credit card, whereas traditional mortgages have fixed borrowing amounts and structured payments. Which mortgage product is most suitable for someone who expects to move within 5 years? Is it A, adjustable rate mortgage, B, fixed rate mortgage, C, balloon mortgage, or D, home equity line of credit? The answer is A, adjustable rate mortgage. An adjustable rate mortgage can be advantageous for short-term homeowners due to lower initial rates compared to fixed-rate mortgages, making it cost-effective if they move before rates adjust.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Why might a borrower choose a fixed-rate mortgage over an ARM? Is it A, they offer lower initial interest rates? B, they require no down payment? C, they have a shorter loan term? Or D, they provide stable monthly payments? The answer is D. They provide stable monthly payments. Fixed-rate mortgages provide predictable monthly payments and protection against interest rate increases, making them appealing for long-term stability and budgeting certainty. What happens if a borrower cannot make the final payment on a balloon mortgage? Is it A, the loan automatically converts to a fixed-rate mortgage? B, the borrower must refinance or sell the property? C, the lender forgives the remaining balance? Or D, the interest rate increases significantly? The answer is B. The borrower must refinance or sell the property. If a borrower cannot make the balloon payment, they must refinance, sell the property, or risk default. This can be challenging if market conditions are unfavorable. Which mortgage product allows a borrower to draw funds as needed up to a certain limit? Is it A, fixed-rate mortgage? B, home equity line of credit? C, balloon mortgage? Or D, adjustable-rate mortgage? The answer is B, home equity line of credit. A home equity line of credit provides flexibility by allowing borrowers to access funds as needed, similar to a credit card, up to a predetermined limit based on home equity. What is a potential risk associated with an adjustable-rate mortgage? Is it A, interest rate increases? B, fixed monthly payments? C, large final payment? Or D, limited access to funds? The answer is A, interest rate increases. ARMs carry the risk of interest rate increases, which can lead to higher monthly payments over time, potentially making the mortgage unaffordable if rates rise significantly. Why might a borrower opt for a balloon mortgage? Is it A, to secure a fixed interest rate? B, for adjustable interest rates? C, for lower initial payments? Or D, to avoid large final payments? The answer is C, for lower initial payments. Borrowers might choose a balloon mortgage for lower initial payments, especially if they plan to refinance or sell the property before the balloon payment is due. Which feature is unique to a fixed-rate mortgage compared to other mortgage types? Is it A, variable interest rates? B, draw funds as needed? C, large final balloon payment? Or D, consistent monthly payments? The answer is D, consistent monthly payments. A fixed-rate mortgage provides stability with consistent monthly payments throughout the loan term, unaffected by market interest rate changes, unlike ARMs. What differentiates a home equity line of credit from a traditional mortgage? Is it A, fixed interest rates? B, access to funds as needed? C, large final payment requirement? Or D, consistent monthly payments? The answer is B, access to funds as needed. A HELOC allows borrowers to access funds as needed, similar to a credit line, whereas a traditional mortgage provides a lump sum that is repaid over time. What is a primary benefit of a fixed-rate mortgage? Is it A, lower initial interest rates? B, predictable monthly payments? C, no down payment required? Or D, flexibility in payment amounts? The answer is B, predictable monthly payments. A fixed-rate mortgage offers stability in monthly payments as the interest rate remains constant throughout the loan term, making budgeting easier for borrowers. How does a balloon mortgage typically differ from a fixed-rate mortgage? Is it A, it requires a large payment at the end of the term? B, it has no interest rate changes? C, it offers lower monthly payments throughout the term? Or D, it requires collateral beyond the property itself? The answer is A, it requires a large payment at the end of the term. A balloon mortgage requires a large final payment at the end of the loan term, unlike a fixed-rate mortgage, which amortizes fully over its term. Which feature is common in an adjustable-rate mortgage? Is it A, fixed interest rate for the entire term? B, large payment required at the end of the term? C, interest rates that adjust periodically? Or D, interest-only payment options? The answer is C, interest rates that adjust periodically. ARMs have interest rates that adjust periodically based on an index, which can lead to fluctuating monthly payments over the life of the loan. What is a significant risk of choosing a home equity line of credit? Is it A, fixed monthly payments? B, limited borrowing flexibility? C, no equity required? Or D, variable interest rates? The answer is D, variable interest rates. A HELOC can lead to variable interest rates, causing payments to increase unexpectedly, which can strain a borrower's financial situation if rates rise significantly. Qualified mortgage versus non-QM. What is one primary characteristic that distinguishes a qualified mortgage from a non-QM loan? Is it A, lower interest rates? B, adherence to specific underwriting standards? C, availability to all borrowers? Or D, government-backed insurance? The answer is B, adherence to specific underwriting standards. Qualified mortgages have specific criteria, like a maximum debt-to-income ratio and no negative amortization, ensuring safer lending practices. Non-QM loans do not follow these criteria and may include non-standard features. Which feature is not allowed in a qualified mortgage QM? Is it A, fixed interest rate? B, adjustable rate? C, interest-only payments? Or D, standard amortization? The answer is C, interest-only payments. Qualified mortgages prohibit risky loan features such as interest-only payments, negative amortization, and balloon payments to protect borrowers and ensure they can repay the loan. Why might a borrower choose a non-QM loan over a QM loan? Is it A, more flexible underwriting standards? B, lower risk of default? C, government insurance? Or D, guaranteed lower interest rates? The answer is A, more flexible underwriting standards. Borrowers with unique financial situations such as irregular income or higher debt-to-income ratios may opt for non-QM loans as they offer more flexible underwriting standards than QMs. What is a T requirement for a mortgage to be classified as a qualified mortgage? Is it A, no down payment required? B, government backing? C, unlimited loan term? Or D, verification of the borrower's ability to repay? The answer is D, verification of the borrower's ability to repay. A key requirement for a QM is that the lender must verify and document the borrower's ability to repay the loan, including income and employment status, ensuring responsible lending practices. Which of the following is a potential disadvantage of opting for a non-QM loan? Is it A, limited availability? B, higher interest rates? C, strict eligibility criteria? Or D, increased documentation requirements? The answer is B, higher interest rates. Non-QM loans due to their flexible standards and higher risk, often come with higher interest rates, which can increase the overall cost of borrowing for the consumer. What is a significant benefit of a qualified mortgage for borrowers? Is it A, higher interest rates, B, enhanced legal protections, C, flexible repayment terms, or D, no documentation requirements? The answer is B, enhanced legal protections. Qualified mortgages provide borrowers with the assurance that the loan adheres to specific underwriting standards, reducing the risk of default and offering greater legal protections. Which aspect of non-QM loans might attract self-employed borrowers? Is it A, lower down payment requirements, B, standardized interest rates, C, alternative income verification, or D, government-backed guarantees? The answer is C, alternative income verification. Non-QM loans offer flexible underwriting criteria, often allowing self-employed individuals to qualify based on alternative income verification methods, such as bank statement programs. How does the debt-to-income ratio requirement differ between Q and non-QM loans? Is it A, QM loans have a maximum DTI of 43%, B, non-QM loans require a DTI under 30%, C, both QM and non-QM have the same DTI limits, or D, QM loans have no DTI restrictions? The answer is A, QM loans have a maximum DTI of 43%. Qualified mortgages have a maximum DTI ratio of 43% to ensure borrowers can manage their mortgage payments, while non-QM loans may allow higher DTI ratios based on lender discretion. Loan features, interest rate, API, PITI, PMI. What does the term APR stand for in mortgage terms? Is it A, annual payment rate, B, annual principal rate, C, annual percentage rate, or D, annual premium rate? The answer is C, annual percentage rate. APR stands for annual percentage rate and represents the total cost of borrowing, including interest and fees, expressed as a yearly percentage. It provides a more comprehensive view of the loan's cost than the nominal interest rate alone. Which component is not included in the calculation of PITI? Is it A, B, interest, C, taxes, or D, maintenance? The answer is D, maintenance. PITI stands for principal, interest, taxes, and insurance. Maintenance costs are not part of the PITI calculation. They are separate expenses that a homeowner may incur. How does private mortgage insurance benefit the lender? Is it A, increases the loan interest rate, B, protects against borrower default, C, reduces the loan term, or D, lowers the borrower's monthly payment? The answer is B, protects against borrower default. PMI protects the lender from losses if a borrower defaults on a loan. It is typically required when a borrower makes a down payment of less than 20% of the home's purchase price. Which factor primarily influences the interest rate on a mortgage? Is it A, borrower's credit score, B, age of the borrower, C, type of property, or D, location of the property? The answer is A, borrower's credit score. The borrower's credit score is a primary factor in determining the interest rate. Higher scores generally lead to lower rates, reflecting the lender's assessment of the borrower's creditworthiness. What does the interest component of PITI represent? Is it A, annual property taxes, B, homeowner's insurance premium, C, cost of borrowing money, or D, loan principal repayment? The answer is C, Cost of borrowing money. Interest is the cost of borrowing money from the lender, calculated as a percentage of the loan principal. It is paid over the loan term and forms part of the monthly mortgage payment. What is the primary purpose of the annual percentage rate in a mortgage loan? Is it A, to determine the monthly mortgage payment, B, to assess the creditworthiness of the borrower, C, to provide a true cost comparison of loan offers, or D, to calculate the property tax component of PITI? The answer is C, to provide a true cost comparison of loan offers. APR provides a comprehensive measure of the cost of borrowing, including interest rate and other fees. It helps borrowers compare different loan offers by reflecting the total cost of the loan. Which component of PITI is directly affected by changes in local government policies? Is it A, principal, B, property taxes, C, interest, or D, insurance? The answer is B, property taxes. Property taxes are influenced by local government policies. Changes in tax rates or assessments can impact the property tax component of PITI, affecting overall mortgage payments. What does the insurance component of PITI cover in a mortgage? Is it A, life insurance for the borrower, B, homeowner's insurance for property protection, C, health insurance for the borrower, or D, car insurance for vehicles on the property? The answer is B, homeowner's insurance for property protection. The insurance in PITI typically refers to homeowner's insurance, which covers potential damages to the property. It is a required component to protect the lender's investment in the property. Amortization and payment calculations. What is the primary purpose of amortization in mortgage payments? Is it A, to increase the loan balance over time, B, to calculate interest-only payments, C, to systematically reduce the loan balance over time, or D, to adjust the interest rate periodically? The answer is C, to systematically reduce the loan balance over time. Amortization in mortgage payments is designed to systematically reduce the loan balance over time while covering interest costs. This ensures that by the end of the loan term, the borrower has fully paid off the principal amount. How does a fully amortizing loan differ from an interest-only loan? Is it A, it includes principal payments from the start, B, it never reduces the principal balance, C, it requires a balloon payment at the end, or D, it has a variable interest rate? The answer is A, it includes principal payments from the start. A fully amortizing loan includes both interest and principal in each payment, reducing the balance over time. An interest-only loan requires only interest payments initially, with the principal repaid later. Which factor primarily influences the monthly payment amount on a fixed-rate mortgage? Is it A, the borrower's credit score, B, the interest rate on the loan, C, the property tax rate, or D, the loan origination fee? The answer is B, the interest rate on the loan. The interest rate is the primary factor affecting monthly payments on a fixed-rate mortgage. A higher rate increases the payment, while a lower rate decreases it, assuming the principal and term remain constant. What happens to the interest portion of a mortgage payment over time in a typical amortization schedule? Is it A, it remains constant throughout the loan term, B, it increases as the loan term progresses, C, it fluctuates based on market conditions, or D, it decreases as the principal balance reduces? The answer is D, it decreases as the principal balance reduces. In a typical amortization schedule, the interest portion of the payment decreases over time as the principal balance is reduced. This is because interest is calculated on the remaining balance of the loan. What is the effect of making additional principal payments on a fixed-rate mortgage? Is it A, It reduces the total interest paid over the life of the loan. B. It increases the loan term. C. It has no effect on the loan. Or D. It increases the monthly payment. The answer is A. It reduces the total interest paid over the life of the loan. Making additional principal payments on a fixed-rate mortgage reduces the overall interest paid and shortens the loan term. This is because the extra payments decrease the principal balance, leading to less interest accruing over time. How does an adjustable-rate mortgage affect the amortization schedule compared to a fixed-rate mortgage? Is it A. It shortens the loan term automatically. B. It maintains a consistent payment schedule. C. It results in variable monthly payments. Or D. It eliminates the need for amortization. The answer is C. It results in variable monthly payments. An adjustable-rate mortgage has interest rates that change over time, leading to fluctuating monthly payments and a variable amortization schedule. This contrasts with a fixed-rate mortgage, where payments remain consistent. What impact does increasing the loan term have on the monthly mortgage payment and total interest paid? Is it A. Lower monthly payments, higher total interest? B. Higher monthly payments, lower total interest? C. No change in monthly payments or total interest? Or D. Higher monthly payments, higher total interest? The answer is A. Lower monthly payments, higher total interest. Increasing the loan term typically reduces monthly payments but increases the total interest paid over the life of the loan. This is because the interest accrues over a longer period. Which component of a mortgage payment typically decreases over time in an amortizing loan? Is it A. Principal, B. Interest, C. Taxes, or D. Insurance? The answer is B. Interest. In an amortizing loan, the interest portion of the payment decreases over time as more of the principal is paid down, while the principal portion increases. What is the effect of a higher interest rate on the monthly payment and total interest of a mortgage? Is it A. Lower monthly payment, higher total interest? B. Higher monthly payment, lower total interest? C. No change in monthly payment or total interest? Or D. Higher monthly payment, higher total interest? The answer is D. Higher monthly payment, higher total interest. A higher interest rate increases both the monthly payment and the total interest paid over the life of the loan, as more money is required to cover the increased cost of borrowing. Underwriting Fundamentals. What is the primary purpose of underwriting in the mortgage process? Is it A. To determine the interest rate for the borrower? B. To finalize the loan amount? C. To assess the risk of lending to the borrower? Or D. To approve the property for sale? The answer is C. To assess the risk of lending to the borrower. Underwriting is the process of evaluating the risk of lending money to a borrower. It involves assessing the borrower's credit history, income, and ability to repay the loan, ensuring the lender's investment is secure. Which factor is considered most critical by underwriters when evaluating a borrower's application? Is it A. Employment history, B. Credit history, C. Property location, or D. Loan term? The answer is B. Credit history. Credit history is crucial as it reflects the borrower's past financial behavior, indicating their reliability in repaying debts. It significantly influences the underwriting decision. How do underwriters use the debt-to-income ratio in the mortgage approval process? Is it A. To evaluate the borrower's ability to manage monthly payments? B. To set the interest rate of the mortgage? C. To determine the property value? Or D. To calculate the down payment requirement? The answer is A. to evaluate the borrower's ability to manage monthly payments. The debt-to-income ratio helps underwriters assess whether a borrower can manage monthly payments. It compares monthly debt obligations to gross monthly income, indicating financial stability and repayment capacity. What role does an appraisal play in the underwriting process? Is it A, to verify the borrower's employment status, B, to determine the property's market value, C, to check the structural integrity of the property, or D, to finalize the closing costs? The answer is B, to determine the property's market value. An appraisal provides an independent estimate of the property's market value, ensuring the loan amount is appropriate and protecting the lender from overlending on an overvalued property. Why might an underwriter request additional documentation from a borrower? Is it A, to delay the loan approval process, B, to increase the loan amount, C, to verify the appraisal report, or D, to clarify or verify financial information? The answer is D, to clarify or verify financial information. Underwriters may require further documentation if initial information is insufficient or unclear, to ensure all aspects of the borrower's financial situation are accurately assessed and risks are minimized. What is the significance of the loan-to-value ratio in the underwriting process? Is it A, it measures the borrower's income stability, B, it determines the borrower's credit score, C, it assesses the risk level of the loan, or D, it calculates the property's market value? The answer is C, it assesses the risk level of the loan. The loan-to-value ratio is crucial as it helps underwriters assess the risk of lending. A higher LTV indicates higher risk, as it means the borrower has less equity in the property. How does an underwriter evaluate a borrower's employment history? Is it A, by checking the borrower's social media profiles, B, by reviewing employment verification documents, C, by analyzing the borrower's tax returns, or D, by contacting previous landlords? The answer is B, by reviewing employment verification documents. Underwriters evaluate employment history to ensure job stability and predictability of income. Typically, a 2-year history is reviewed to assess consistency and reliability of employment. Which document is essential for verifying a borrower's income during underwriting? Is it A, pay stubs, B, credit report, C, title insurance, or D, property appraisal? The answer is A, pay stubs. Pay stubs are essential for verifying a borrower's income, as they provide recent proof of earnings, allowing underwriters to assess income stability and sufficiency for loan repayment. What is the purpose of a credit report in the underwriting process? Is it A, to determine the property's market value, B, to assess the borrower's creditworthiness, C, to verify the borrower's employment status, or D, to calculate the loan's interest rate? The answer is B, to assess the borrower's creditworthiness. A credit report is used to evaluate a borrower's creditworthiness by providing a detailed history of their borrowing and repayment behavior, which helps underwriters assess the risk of default. Mortgage insurance types and requirements. What is the primary purpose of private mortgage insurance? Is it A, to protect the borrower against interest rate increases, B, to protect the lender against borrower default, C, to reduce the overall mortgage interest rate, or D, to ensure the property is adequately insured? The answer is B, to protect the lender against borrower default. Private mortgage insurance protects the lender against losses if a borrower defaults on their mortgage. It is typically required when the down payment is less than 20% of the home's purchase price. Which of the following is typically required for an FHA loan? Is it A, mortgage insurance premium, B, private mortgage insurance, C, no mortgage insurance is required, or D, title insurance? The answer is A, mortgage insurance premium. FHA loans require mortgage insurance premiums regardless of the down payment amount. This insurance protects lenders against losses from borrower default. When can PMI typically be canceled on a conventional loan? Is it A, after 5 years of consistent payments, B, once the home value increases by 10%, C, when the loan-to-value ratio reaches 80%, or D, only when the mortgage is fully paid off? The answer is C, when the loan-to-value ratio reaches 80%. PMI can usually be canceled once the borrower has paid down the mortgage to 78% of the original home value, or the loan-to-value ratio reaches 80% through payments or appreciation. What is a key difference between PMI and MIP? Is it A, PMI is government-backed, MIP is not, B, MIP is for conventional loans, PMI is for FHA loans, C, both are required for all types of loans, or D, PMI can be canceled, MIP may be required for the loan's life? The answer is D, PMI can be canceled, MIP may be required for the loan's life. PMI applies to conventional loans and can often be canceled when certain conditions are met, while MIP applies to FHA loans and may be required for the life of the loan. Which type of mortgage insurance is typically required for a VA loan? Is it A, no mortgage insurance, but a funding fee is required, B, private mortgage insurance, C, mortgage insurance premium, or D, all PMI and MIP are required? The answer is A, no mortgage insurance, but a funding fee is required. VA loans do not require mortgage insurance, but they do require a one-time funding fee that helps offset the program's cost and reduces the risk to taxpayers. Government Loan Program Guidelines. Which government loan program is specifically designed to help veterans and their families obtain home financing? Is it A, FHA loan, B, USDA loan, C, VA loan, or D, conventional loan? The answer is C, VA loan. The VA loan program, managed by the Department of Veterans Affairs, provides veterans and their families with favorable loan terms, including no down payment and competitive interest rates. What is the primary benefit of a USDA loan for eligible rural homebuyers? Is it A, lower interest rates than VA loans, B, no down payment required, C, available to all homebuyers, or D, no mortgage insurance required? The answer is B, no down payment required. USDA loans offer 100% financing with no down payment required, making them an attractive option for rural homebuyers who meet the income and location criteria. Which of the following is a characteristic of an FHA loan? Is it A, lower down payment requirements, B, exclusively for first-time homebuyers, C, no mortgage insurance required, or D, available only in rural areas? The answer is A, lower down payment requirements. FHA loans are known for their lower down payment requirements, often as low as 3.5%, which makes them accessible to first-time homebuyers with lower credit scores. What is a significant advantage of VA loans compared to conventional loans? Is it A, lower closing costs, B, higher loan limits, C, available to all borrowers, or D, no private mortgage insurance required? The answer is D, no private mortgage insurance required. VA loans offer the benefit of no required down payment and no private mortgage insurance, making them financially advantageous for eligible veterans. What is a common eligibility requirement for obtaining a USDA loan? Is it A, minimum credit score of 700, B, property must be a multifamily dwelling, C, property must be in a rural area, or D, borrower must be a first-time home buyer? The answer is C, property must be in a rural area. USDA loans require that the property be located in a designated rural area and that the borrower's income does not exceed certain thresholds specific to the area. Which type of government loan program is specifically designed to assist low-income borrowers in rural areas? Is it A, FHA loan, B, USDA loan, C, VA loan, or D, conventional loan? The answer is B, USDA loan. USDA loans are targeted at low to moderate income borrowers in rural areas, offering benefits such as zero down payment and reduced mortgage insurance costs, making homeownership more accessible. What is a key feature of the VA loan program that benefits eligible military personnel? Is it A, no down payment requirement, B, higher interest rates, C, mandatory mortgage insurance, or D, strict income limits? The answer is A, no down payment requirement. VA loans offer the benefit of no down payment for eligible veterans, active duty service members, and certain members of the National Guard and Reserves, making homeownership more accessible. Which government loan program requires an upfront mortgage insurance premium? Is it A, VA loan, B, USDA loan, C, FHA loan, or D, conventional loan? The answer is C, FHA loan. FHA loans require borrowers to pay an upfront mortgage insurance premium as well as an annual premium, which are used to protect lenders against borrower default. Which loan program is available to Native American veterans for housing on federal trust land? Is it A, FHA loan, B, USDA loan, C, VA loan, or D, Native American direct loan? The answer is D, Native American direct loan. The Native American Direct Loan Program assists Native American veterans in purchasing, constructing, or improving homes on federal trust land, offering favorable terms similar to VA loans.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Secondary market and investor roles. Which of the following is a primary role of the Federal National Mortgage Association in the secondary mortgage market? Is it A, providing liquidity by purchasing mortgages from lenders, B, directly lending money to homebuyers, C, setting interest rates for mortgages, or D, insuring mortgages against default? The answer is A, providing liquidity by purchasing mortgages from lenders. FNMA, or Fannie Mae, primarily buys mortgages from lenders to provide liquidity, allowing lenders to issue more loans. This helps stabilize the mortgage market and supports affordable housing. What distinguishes the Government National Mortgage Association from other secondary market entities? Is it A, it purchases loans from private lenders, B, it sets mortgage interest rates, C, it guarantees mortgage-backed securities, or D, it insures loans against borrower default? The answer is C, it guarantees mortgage-backed securities. GNMA, or GNMA, is unique in guaranteeing mortgage-backed securities, ensuring timely payment of principal and interest, which reduces risk for investors and supports government lending programs. What is a key function of the Federal Home Loan Mortgage Corporation in the mortgage market? Is it A, setting underwriting standards for all mortgages, B, purchasing mortgages to provide liquidity, C, directly financing large-scale housing projects, or D, guaranteeing private mortgage insurance? The answer is B, purchasing mortgages to provide liquidity. FHLMC, or Freddie Mac, purchases mortgages from lenders to provide liquidity and stability, similar to FNMA, but it also focuses on supporting affordable housing initiatives. How does the secondary mortgage market benefit lenders? Is it A, by setting lower interest rates for borrowers, B, by providing direct federal funding to lenders, C, by reducing the need for mortgage insurance, or D, by allowing them to sell loans and free up capital? The answer is D, by allowing them to sell loans and free up capital. The secondary market allows lenders to sell loans, freeing up capital to issue new loans. This process enhances liquidity and enables lenders to manage risk and meet consumer demand. Which entity is primarily responsible for supporting government-insured loans in the secondary market? Is it A, FNMA, B, GNMA, C, FHLMC, or D, Federal Reserve? The answer is B, GNMA. GNMA, or GNMA, supports government-insured loans by guaranteeing mortgage-backed securities, ensuring investors receive timely payments, and enhancing the attractiveness of these loans. Conforming versus non-conforming loans. Which of the following is a characteristic of a conforming loan? Is it A, exceeds loan limits set by Fannie Mae, B, meets Fannie Mae and Freddie Mac guidelines, C, typically has higher interest rates, or D, includes jumbo loans? The answer is B, meets Fannie Mae and Freddie Mac guidelines. Conforming loans adhere to Fannie Mae and Freddie Mac's guidelines, including loan limits. They offer lower interest rates due to reduced risk for lenders. What defines a non-conforming loan? Is it A, it is guaranteed by the FHA, B, it always has a fixed interest rate, C, it does not meet Fannie Mae or Freddie Mac guidelines, or D, it is only available for commercial properties? The answer is C, it does not meet Fannie Mae or Freddie Mac guidelines. Non-conforming loans do not meet FANNIE or FREDDIE-MAC guidelines, often due to size or borrower credit profile, leading to higher interest rates. Why might a borrower choose a non-conforming loan? Is it A, to obtain a larger loan amount, B, to secure a government guarantee, C, for lower interest rates, or D, for easier qualification requirements? The answer is A, to obtain a larger loan amount. Borrowers might choose non-conforming loans for higher loan amounts, or if they have unique financial circumstances, even if it means higher interest rates. Which type of loan is typically easier to sell on the secondary market? Is it A, non-conforming loans, B, FHA loans, C, VA loans, or D, conforming loans? The answer is D, conforming loans. Conforming loans are easier to sell on the secondary market due to standardization and lower risk, making them more attractive to investors. How does a jumbo loan differ from a conforming loan? Is it A, it requires lower credit scores, B, it has government insurance, C, it exceeds conforming loan limits, or D, it offers lower interest rates? The answer is C, it exceeds conforming loan limits. jumbo loans exceed conforming loan limits set by Fannie Mae and Freddie Mac, often resulting in stricter credit requirements and higher interest rates.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.